Hey everybody, what's good? It's Walter McCormick with Walter McCormick Insurance coming at you with another practical insurance video. I work very hard to try to make this subject not totally boring, so I would appreciate it if you guys watch all the way through the end and you like what you see. Be sure to hit the subscribe button or like button and share this out with someone if you can find it would be useful to them. So today what we're going to be going over is how can term insurance help you, or how term insurance can help you pay off your mortgage. Okay, so most people have heard buy term insurance, it's cheap, it's whatever, but this is actually a practical foundational step that you can do to actually benefit paying off your mortgage on an earlier timeline. So in order to illustrate this, we're going to be going over a couple of examples here, okay? So first person is a 32-year-old non-smoker well, here, I'll just do this. A smoker, 32-year-old smoker, good health class. So let's say this guy is Joe. I have a lot of Joes in my video if you didn't already know. So, two things. The concept that we're showing here today is called mortgage protection. Okay? So Joe and his wife is Susan. Okay? That's her hair. It's not very good hair, but hey, we'll give her a free pass, okay? So they buy a house. And that house costs $250,000, okay? So their house is $250,000. So Joe is the primary. He makes more money. Susan makes less money, but she makes some. You know, she does work. She makes some money. So what happens if something happens to Joe? So this would create a massive problem. She would have most of, let's say this is a 30-year mortgage, and 4.5% interest. Okay? So Susan would be left holding the bag on this house, and let's complicate matters. She's got a little baby, and this is little Joey. Okay? So you got Susan and little Joey. Joe's out of the picture. He met his demise somehow. And she's stuck with a $250,000 house with a 4.5% mortgage on it, right? So this is where mortgage protection comes into play. So erase all that, okay? So, the need, and this is not counting his other income, etc., etc. This is just mortgage protection. So $250,000 is the mortgage. Okay? So Susan on her own can't afford that. But Joe was a nice guy, and he got a, what did I put? $250,000? $250,000 term life insurance. So that pays out, boom, mortgage is knocked out. Now, let's say from the time he bought this right when he purchased his house. So same day, he got his life insurance, got his mortgage the same day. So those match. So now let's say he had paid 5 years off. And let's say his principal was $225,000. So that would have paid off the mortgage, and it would have left Susan with an additional $25,000. So you see how this works. As you pay off the mortgage, the amount that goes to the spouse would be more because it's obviously what the original amount was. Okay? So now there's two strategies, and this is actually what the title of the video is, how you can use it to pay off your mortgage. So let's say you've got a 30-year mortgage. Okay? Now, what we're going to do is we're going to take out a 20-year term. And this term is going to have something called return of premium, or cash back. So basically everything that you pay in to this life insurance policy, here's life insurance, that's LI, okay? Everything you pay into that life insurance you get back. So what does that look like? Okay, so the non-return of premium, so this is just level term for $250,000. Okay, is going to be $487.50 for Joe, the 32-year-old smoker, for 20 years. Okay, so that makes sense. So over a span of 20 years, let me get my calculator here. So 487.50 times 20 years, he's going to pay a total of $9,750 to cover that mortgage. Okay? So that makes sense. You know, that's pretty reasonable. Okay? So now let's do the cashback mortgage payoff method. Okay? So, same $250,000. The annual premium on this one is going to be $1,590. No, $1,590 per year. Okay? Now, how does this pay off your mortgage, you say? Well, this is a 20-year. So at the end of 20 years, he is going to get back an amount of $31,800. Now, here's your question. So you've been paying into that mortgage, you've effectively paid it down over that time where you're paying mainly principal off in the last little bit. So then what you do is you take this entire premium that you get back and you pay it and you get rid of the mortgage. Okay? So that's just one way that you can practically use life insurance to handle that specific thing. I know there's all sorts of refinancing and this, that, and the other that we did not go into, but let's just say simple. You have a 30-year mortgage, you do 20-year term, you get your cash back 20 years later, 10 years left on the mortgage, and you use all that money to pay it off. So if you have any other questions, feel free to reach out to me. I appreciate you guys watching my video. You can find me at Walter McCormick Insurance on any social media channel. I look forward to seeing you guys in my further videos. Have a great day. Stay awesome.